Good day. I'm Martin Gagel with Market Radius Research. It's Thursday, May the 11th, and we've got CEO Fred Dugre of H2o Innovations. H2O is a water technology and water solutions company, and the company just released its March quarter, Q3 fiscal 2023, which saw the company growing revenues by 31.7% to $68 million. CEO Fred Dugre is here to discuss the quarter with us, but please remember, this is neither recommendation or investment advice. We're here to learn about the company. Fred, great seeing you again. Another strong revenue growth quarter. You guys posted again with big revenue growth, backlog growth, and more. Why don't you tell us, give us some highlights on what happened in the quarter?
Well, indeed, as you said, I mean, you pointed out growth is really happening in every single aspect of our business. In all our business pillars, we're experiencing growth. It is quite exciting to see it, and print these numbers, and not only growing the top line, but despite the volatility and the challenges related to wage and wage pressure and inflation and salaries and material, we're still able to preserve a 10% margin EBITDA for the quarter. So in a nutshell, I mean, the trajectory that you see there is a combination of the acquisitions we have done, but also the sustained organic growth that we're posting once again for this quarter. So 17.8, almost 18% organic in this second quarter. So it is really nice to see this. Our team is really engaged. And what I like the most is that I don't see anything ahead of us that tells us that we're going to see a slowdown. Our industry is really into an inflection point, driven by tremendous water needs, driven by reshoring from American companies, building new facilities or expanding their manufacturing facilities in the US. The desalination market continues to grow overseas. So we think we still have really good years ahead of us to maintain such kind of organic growth.
With your organic growth, just can you give everyone a reminder, obviously good organic growth, where were your acquisitions done last year that was the sort of acquisitive growth that added on to the company?
So the acquisition that we have done last year was the one for a Maple related acquisition, the acquisition of Leader Evaporator. It was completed on June 30th. So this represents a little portion of our growth, but the vast majority, again, as we said, out of the 31% growth that we're showing, 18%, so slightly more than the half, was represented by the organic only.
All right.
And what's nice is that we keep this higher recurrent revenues. I mean, we have shown, starting from the pandemic to this inflation period, that our business, our sector, is very resilient. When was the last time you heard that the water or wastewater plant was shut down or reduced into operations? Never. So the recurrency that we have into our business model, the combination of the consumables, the chemicals, the support from operation and maintenance, is providing us excellent visibility. I mean, with 87% almost of recurrent revenues, but also the fact that we're sitting on a large backlog of 203 million. I mean, it's up 86% compared to the last year, the same period. So this is obviously giving us great vision for the coming quarters and coming years.
Well, that backlog growth is very impressive. You've got the three divisions. We'll go through them sort of individually, but can you give us a bit of an overview on sort of, I guess, what's driving that backlog or what's it consisting of?
Well, there's two main drivers to this important growth. I mean, one is coming from the O&M. I mean, there was a big project secured for the city of Gulfport. We can talk about it later when we go to the operation and maintenance. But overall, I mean, the WTS team, the capital equipment business, has been growing, tremendously over the last 12 months, adding new projects, securing new opportunities with existing and new customers of large size, going from the largest electrical car manufacturing companies to the largest data center in the US, also. So the corporation, H2o Innovation, now is dealing with major, massive industrial customers which is enabling us to grow this capital equipment backlog, at better margins too.
And the capital equipment business, does that also typically leads to recurring revenues on maybe the specialty products business thereafter as well?
Yep. Well, the rule of thumb I will say is that out of a capital equipment project, there's usually 10% of the value of the capital equipment projects that represent potential consumables and repeat sales and recurring revenues. So let's say we delivered about $10 million of new equipment, of new projects. It might be 2 or 4 projects, let's say. Well, out of this 10 million, there is within this 10 million a possibility of $1 million worth of consumable sales and repeat revenues. So this is why this transition from WTS to consumables to service to operation and maintenance is very, very important. And that's what our team is doing. That's why, more and more we are materializing these synergies among our different business lines.
All right. Why don't we go through the different business lines here and see a little more granularly there?
Absolutely. So starting with the operation and maintenance, well, I mean, as you see there, I mean, the business, we're not only growing the business and adding new customers, but we're doing the number one thing, which is renewing and keeping our existing customers, right? So we focus equally in not only growing, but keeping our existing customers. This is the main and basic strategy, to make sure that we keep our customers and expand the scope of work from what we have. So you see the renewals over the last 12 months, plus the scope expansion, 15 scope expansion, in the last 12 months, and 18 new ones. So this business is growing. We're growing into different states. We had 3 new operation and maintenance contracts, state of New York and New Hampshire, as well as Alberta. So in Canada as well, we're growing progressively the operation and maintenance. We got also a new contract, that we won from a plant that WTS delivered. So Piedmont Medical Center, where WTS, the capital equipment division, start up a new water reuse facility, was now took over by the operation and maintenance team. They have been able to convert this customer into a 2-year contract, operating now the facility, operating the plant. So again, it shows the synergies between the two. And finally, it is absolutely important to mention the awards that we got, not because of the price itself. Yes, we're proud, but it shows the level of attention and hard work done by our team every day to go above and beyond and make sure they provide best service to our customers for the city of Canton and for the city of Town of Warren. So for us, it's really, really important to show care to our customers, and we're not making compromise on environmental compliance. So
well, and I would think like every municipality or business is looking to save money, but you're not going to compromise the quality of the water, or if your service provider fails or doesn't do their job, that like people get, well, you would get fired, but like people would get unelected and so forth for if you can't rely on the water.
Absolutely. And we will prefer to say, Mr. Customer, these are our recommendations. These should be the investment that you should be doing to be compliant with your plan. If you're not in agreement with it, well, we prefer to terminate the contract than taking the risk, to continue. So we're very, very diligent on this, and we're not making compromise on environmental compliance.
Yeah. When you're doing the O&M business, I presume you're also purchasing equipment or supplies from your specialty products as well, the chemicals and the new filters or the sort of daily use type stuff. Is that fair to say? So this went from capital equipment to O&M as well, then some specialty products included?
When we can, indeed. It depends again on the kind of equipment that we're operating. If it's a conventional systems like a sequential batch reactor, so there might not be chemicals we're going to provide because they're more like generic chemicals.
Okay.
But in the case of a membrane plant, yes, we're going to provide, all the chemicals, the consumables, and so on.
All right.
Like the plant you see behind me is a picture of Moss Point in Mississippi. This plant, even though it wasn't built by us, is operated by us, And they have now our chemicals, they have now our filters, they're now using all our consumables. So when it's a membrane plant, absolutely yes, we're taking advantage of that and bringing all the synergies.
All right.
If you look at the growth and the evolution, well, we talk about the backlog. So this big jump was essentially, coming from one large operation and maintenance contract for the city of Gulfport that was renewed, but also multiple other ones that we won. It's worth to mention, though, that, all the evergreen contracts in the O&M, and that there's a lot, mostly in the state of New York and into Texas, they're not part of the backlog because there are evergreen. So, and that represents about 30% of the overall revenue. So it is still important, and it's not even included into the backlog, despite the fact that, yes, they are highly recurrent, however. So I wanted to add some color there. And you see the revenues there on an LTM basis, keeps growing. We're pushing really hard to continue to improve the margin as well, despite this pressure that we have faced, on high inflation on wages. We're pursuing, this strategically for each of our customers to push for CPI adjustment at the anniversary date of each of our contract.
All right. So as contracts get renewed, you're getting putting in or negotiating in the best inflation sort of protection clauses in there.
That's right.
All right.
Looking at the water technology and services, WTS. Well, I mean, these guys are really, really busy. I mean, not only winning new projects, as you can see there, 5 new jobs, 5 new projects they have secured, 4 industrial, 1 municipal, with a variety of different technologies from reverse osmosis to ultrafiltration to more conventional green sand filters. But you see that also the backlog, from the previous year now is starting to hit positively our P&L. Look at the number of projects under the engineering and under commissioning right now. So it's ramping up really fast. So we should see these projects, starting to hit more progressively as well, our P&L. So this is quite exciting for the coming quarters. Also, we did something really cool. I mean, you see this little picture of a beer. So not that we're getting into the beer market, but we have team up with a microbrewery and the city of Las Virgenes to create the first water reuse beer. So it is essentially a beer, as you know. I mean, the main ingredient of beer is water, and this water is coming from a water reuse plant that we delivered to the city a couple of years ago in 2020. So we want to do this to illustrate and engage a little bit more, the audience into the conversation, into the topic of not being afraid to use and drink water reuse. So there's a lot of social acceptance that is coming out of this, and we're taking advantage of this, marketing platform to convey it to different stakeholders. So that was good. We did that in the context of a water reuse conference in Georgia a couple of months ago.
All right.
The backlog keeps growing, as we said. I mean, thanks to the number of projects they have secured. I mean, this keeps growing, and growing not only in dollars, but growing in margin profile as well. And that excites me a lot because we put a lot of work and emphasis to be more and more selective on opportunities we're going after, and it is starting to really pay off. So this is why the projects that we're going to recognize in the coming quarters will be at better margin. So we should see an appreciation of the margin moving forward as well.
Well, that's interesting because the quarter overall did, I guess, largely through the O&M, have some margin pressure on it. But on the WTS side, it's actually expanding here. And so you're just, I think you're focused more on industrial clients where you have a little more, those better margin profile in that business. Could you just talk about why this sector or this division hasn't been hit so much by the inflationary pressures?
Well, now, I mean, the projects we bid, we bid it with the latest material adjustment. So we bid to market in a sense that if the price of steel goes up or if the price of a pump goes up, it is reflected in my bid when I bid a new project, right? So let's say one of the material, the membrane goes up, the price of membrane goes up, the price of pressure vessel, the price of steel, the price of pump goes up. I reflect that in my bid proposal, right? In a position when you do operation and maintenance, you're already engaged into a long-term contract. I have no choice but to provide, salary and base salary adjustment to my employees if I want to keep them, because to perform, I must have these employees. Now, over time, I will be able to catch up with the city as I hit or arrive at the anniversary date of my contract. I'll then sit down with the customer. I may propose a few things: CPI adjustment, scope of work expansion, maybe more flexibility into the full-time employees, requirements that the city is having with us. So all these different things will be discussed and addressed at the anniversary date of each contract, allowing us to improve the margin. But in this case, for WTS, the bids, when we secure a project, it reflects, the latest price adjustment of all material and wages.
All right. And on the WTS business, this is a global business as well. You do, it's not just North America, you do international work as well?
The WTS is North America. This is US and Canada.
Okay, gotcha. And is this primarily the US, or is there a mix of Canadian and US business in there? And I'm just curious on how that is shifting, or is there larger growth in in one market or the other?
It's mostly US. I would say 65 to 70% is about US, and the remaining is Canadian.
Okay.
I mean, let's put it this way: we're 36 million population. I mean, US is 10 times bigger. So, and 10 times the problem related to water because of the scarcity from the southern states. So, our strategy is first to address this market. We have resources, we have people, we have references, we have experience. So we're spending a lot of energy and efforts towards this, and while remaining, active in Canada as well.
Yeah. All right.
All right. The last business pillar is the specialty products. In this case, also, we have seen tremendous growth coming from all our divisions, from the chemicals to the component business to the maple business. I would say there's a couple of drivers, behind this that we clearly observe, and we have been observing now for almost 24 months, is the appetite or recognition from our customers now, and the new one, regarding eco-friendly solutions, eco-friendly products, green chemistry. So now it seems that we're setting ourselves really apart from our competitors with the portfolio of products we have, because we're allowing our customers to reduce their freight costs, to reduce their warehousing costs, to reduce their water footprint, to save energy. So all of the above are driving factors and strong differentiators, allowing us to gain new business and have amazing momentum into our sales. The maple farming equipment also business was good, was strong. As I mentioned earlier, we did the acquisition of Leader. We were in transition for integration and reorganization on that new company that we had acquired last year. Keep in mind that we inherited, from an existing backlog when we acquired the company. And obviously we wanted to keep our engagement with these customers, and we delivered on these products and these projects without, making adjustment on price. So this is why for us right now, when we project ourselves looking forward, we have, great confidence that we should see margin improvement from that particular business line, the maple, because, we're now reflecting, price adjustment to our customers for the new season. So this is also encouraging, in terms of margin improvement.
You had an existing maple business, you've bought Leader, you've integrated them. Has that and you've now gone through the busy season, the winter season. Have those operations been fully integrated at this point, and did that go as expected?
Well, the integration still goes on. We have done great progress. We're not out of the integration period yet. I mean, the priority for us was essentially, two things. First, let's try to do everything we can to keep Leader's clients, engaged with the company through this transition, because some of them were worried about what's going to happen. So that was test or the task number one. Task number two was try to keep our employees engaged with this new venture with H2o Innovation and retain the talent as much as we can. So these two were accomplished. Now we're getting into the more integration. So we have streamlined the number of SKUs, we have streamlined and combined the portfolio of products, eliminated some redundant products that were at lower margins, products that were not necessarily the top of the list. So now we have streamlined, this product line. We're working on the supply chain to improve also some of the terms and conditions with key suppliers. And now we're re-engaging into not only growing, but improving significantly the margins of that business. And so this is quite exciting moment now. And we're still making use. So we have two factories, one in Vermont and one in Quebec, where we're making products on both sides of the borders. And we're really proud to say that we're the only maple equipment, manufacturing companies capable of manufacturing on both sides of the borders to serve our customers.
Are you the dominant, are you the largest player in there, or what kind of market share would you have in that market?
We're not the largest one. I would say we have about 18 to 22% of the market shares.
Okay.
If you look at the evolution of the business, well, I think it speaks by itself, looking at the different deliveries of these products, the growth. We have seen the business, present and post sustained growth. However, you see also the pressure on margins for that business pillar. So it is important for us to continue to address price increases and push that to customers on a timely manner, depending on the geographies where they are. So we want to be extremely diligent. We do not want to push, just across the board a percentage of increase, but we want to be diligent depending on what type of products they're buying, depending on what geographies they are. So we should see also improvements, down the road in margins on that business pillar. On the LTM basis, where you see how we have been growing the business, if you compare the 2 years, now on a LTM basis, we're looking at 240 million. This is phenomenal growth, as we said, a combination of organic growth, but also, coming from strong organic growth. I mean, on an LTM basis, we're posting organic growth of 23%. So this is quite significant. There was growth coming from acquisition as well, representing about 17% of the overall growth, and the impact also of the tailwind that we had from the exchange rate, which represent 4.6%. But still phenomenal growth, 43% of growth, LTM basis over LTM basis. As I said earlier, the pressure is on margin for multiple consideration between the wages, between the salaries and the materials. So we're taking steps. We have a clear roadmap on things we're going to improve and have improved and will continue to improve, allowing us to regain, these points of margins. So that's how we feel about, the coming quarters and coming years.
Is there a trade-off you have to manage on the margin, call it going down to the EBITDA margin, of sort of balancing, like, could you get higher margins if you slowed the growth down a little bit, or vice versa, you could put pressure on margins if you accelerated the growth? And if so, how are you sort of balancing, though, because everyone likes to see growth, but they also want to see the fat margins? Where's that balance?
Well, there's a little bit of that. I will say it's mostly not that we're trying to slow down, but there's a balance between the business mix. So if on a given quarter, let's say you have more operation and maintenance growth, which we like because it's recurring sales, it's predictable, it's low risk. Well, it calls for lower margins. On the other end, if you have massive, specialty chemical sales, well, it drives the margins up, right? So ideally, you would like to have a business only relying on specialty chemicals, but on the other end, what we created is a platform also in H2O where the complementarity of the business lines, the synergies between the business lines makes a lot of sense. So that's why, we may look at it from a quarter-to-quarter basis, but I think it's better to look at it on a yearly basis to reduce this noise coming from the product mix or business mix from one quarter to the other. but we don't have intention to slow down. We have the intention to be more selective on opportunities, take the ones that are lucrative.
All right. I mean, on the seasonality, obviously the maple business has seasonality to it, but is there much seasonality to the rest of your business?
No, I mean, there's no seasonality into operation and maintenance. There's no seasonality into WTS, neither on international chemical sales or component sales. So it's really only the maple that has some kind of seasonality.
All right.
So this is just a quick recap, obviously, on the growth that we're observing. You know, I mentioned it, 31% growth, combination of organic and external growth from acquisition. SG&A, we're trying to contain it, even though we want to continue growing. So even though moving forward, we may continue to add a couple of sales resources, we want to continue to develop new products as well, but we want to remain under the 17.5-ish kind of SG&A percentage. Gross margin, we talk about it, it's under pressure, but we have a clear roadmap on how we're going to grow and improve there. Being a double-digit EBITDA is still a priority for us, and we're going to do everything we can. And this comes also from the margin improvement that we'll do. I'm very happy to see this cash flow conversion. This cash generated in the last quarter is really good. It's twice as much than what it was last year. And this is important because it will allow us to position, ourselves in a nice way to reduce our debt and be in a position to further grow the company, either from organic initiatives, but also from potential acquisitions. And the backlog, as I said, gives us great visibility for the coming quarters.
Sir, on the cash flow generated, what drove that? You're just being tighter on managing inventories and collecting from clients and that, or what? Because that's very impressive cash improvement in cash generation.
It's all of the above, Martin. I mean, it's a combination of negotiating better terms. I mean, don't forget that we just came out of a huge, turmoil into the supply chain. The supply chain got broken, and suddenly everyone was afraid. So, we have been ordering, quantity of material superior to what we should have been doing. I mean, we went from the just in time to the just enough to the just in case.
Yeah.
So this created an increase into our inventories. It also created a huge, change into the way we're approaching, the supply. So suddenly, not only we have increased the quantity, but we were ordering in a different fashion. Some suppliers, they were requesting to have additional prepaid expenses. So we have been able to improve the cash conversion by negotiating better terms, liquidating or turning our inventory into cash, and yeah, improving the margins in a nutshell and collecting our money. So it's really a combination of actions, that generated this cash, and this is an important priority for us in the coming quarters as well. And this is why you see now this reflected into the net debt as well. So the cash converted allow us to reduce our long-term net debt, bringing it under now the 50 million threshold. And what we're aim at is to convert or reduce this kind of net debt to $5 million or so a quarter. As we continue to do so, it will enable us also to potentially address, a new opportunity for acquisitions moving forward.
All right. So not just on a percentage of revenues in that year, on an absolute basis, your debt is declining here. You mentioned acquisitions. What does the world of acquisitions look like right now in the water world?
Well, if you look at the last column on the conclusion side, you see that it is very busy. I mean, with 126 transactions, completed into our sector. This is like looking backwards in the last 12 months. You have an average value transaction of $774 million US. The trading, multiple of revenues was 2.7 times revenue, almost 14 times, for the EBITDA. So it is an industry where investors have appetite for water. They see the value of water. They see the growing needs of solutions, of technology, of business, for water. And this is mostly for larger transactions. So we think that in our case, when we look and approach opportunities of smaller size, we can still afford them at affordable multiple, where it will still be accretive for H2O Innovation, meaning that we're going to buy them at lower multiple than what we're trading at. So yeah, so we think it's still, there's still a lot of opportunities. We're still have now a nice backlog of opportunities and funnel of targets. But first, we want to take care of our existing business because we're growing so much. It's not like if we were desperate for more growth with the growth that we're having. So that's it. So we should see, additional opportunities for acquisition, emerge in the coming quarters, and we're going to execute on that.
No guarantees or anything, but it is possible that we could see an acquisition coming out of H2O in 2023.
It is possible. It is possible. I mean, it's something that we're actively looking at. Again, the priority for us was to deleverage a little bit. Yeah. At this point, if let's say we finished a year, as I said, we're 49-ish million. Reducing it by another 5 million should bring us to a 45 million or so. This will imply probably a little bit less than 2 times, EBITDA, kind of net debt to EBITDA. So it gives us and put us in a really nice position to reload for another small tuck-ins opportunity acquisition, in the coming quarters.
And sort of an ideal sized acquisition would be what, $10-20 million a revenue, or? Well,
for us, we define the tuck-ins. I mean, that we would do, ideally without, dilution. And that is defined, under the kind of a 25 million below in terms of revenues.
Okay.
So we're looking at different ideas. We're looking in ways also of adding complementary products and solutions that will enable us to improve the margin profile or to serve better our existing customers. So we have clear targets and clear criteria on things we're going after. Yeah. But yeah, so.
All right.
Good.
And basically, the water industry, it's not going away. I guess that's the rest of the slide here is the sector's performing well. There's only growing opportunities, and you're in the heart of it.
Yeah, I mean, let's put it this way. Between all the drivers that we see, in this investment thesis, obviously the one that, aging population, growing population, older infrastructures, water scarcity, and all the emerging contaminants as well, is creating additional pressure on regulators to come up with solutions. So for us, it's clear that we're well positioned. We have a lot of experience. We have complementary solutions between the operation, between the specialty chemicals, products, and our capabilities to design equipment. We're in the best spot. I mean, after 23 years, we couldn't ask better, in terms of business model and the way we're presenting ourselves to the industry.
All right. Well, I think we should wrap things up here. Fred, any concluding comments before we go?
Well, obviously, I'm very excited about our performance of this quarter. As I said earlier, starting the call, I'm excited about the past, but equally excited and confident about the future, because we're still having a good tailwind in terms of opportunities for us in the water sector. But also, I'm confident that with what we have done with our clear roadmap on improving, margins, we have a bright future, definitely. So it's fun to be in the spot where we are now.
All right. Thanks a lot for joining us, Fred. Thanks for giving us an update on H2O's progress, and talk to you again soon. Cheers.
All right. Thank you, Martin. Have a good one.
You too.
Cheers.